Well, I think if you to the report, I think as you've highlighted, most of the factors that have boosted inflation, not only this month but in the last couple of months, have been sort of reopening. If you look at the broader breakdown in most categories, then you're not at this moment getting sort of a broadening of inflation. And I think the bond market initial reaction after the data, where sort of 10 and 30-year yield didn't really spike higher, sort of tells you that at least the traders are taking the view that there isn't a major sort of concern at the moment. But notwithstanding that, this debate will sort of carry on, because there's a risk that the current headline inflation could impact wage settlements, could impact inflation expectations for households and businesses. And the Fed, I think, are going to be watching that very closely.
Well, let's tie this into the Fed, because there is a big dovish contingency in the Fed who would like to see signs that the labor market is also picking up momentum. And so far, the labor reports have been relatively disappointing. You've had several months of upside surprises on inflation, but not so much the case when it comes to the labor market. How do you think they're going to bide their time when it comes to putting the two together? Because, of course, the Fed do have that dual mandate.
I think the Fed will emphasize that they need to see substantial progress, as is the phrase, on both inflation and the labour market. And I think that sort of prohibits the idea of the Fed lifting rates as early as late 2022. But I think we are going to see enough progress over the next couple of months in terms of the labour market, particularly once unemployment benefits taper in the US. That should help labour supply meet the great vacancy openings that currently exist. And I think that will prove to be sort of a second momentum for the US economy, which will ultimately lead the Fed to taper in December and to actually hike rates in 2023.
Mike, can I ask you what your market thesis is from here? It feels as though the market reflation trades have really been struggling the last month or so. And if you were betting on a hawkish response out of some of the advanced economy central banks, then you would have been disappointed. How do you see things, and where is the investment opportunity in the second half of the year?
It's going to be a bit of a rocky sort of second half, because the sugar high from the reopening and the checks in the US will fade, and we're more back to sort of traditional type of recovery, and that's not going to look as good as Q2. Consequently, the GDP numbers will be a bit choppier. They'll still be good, but the market will start to look forward to 2022 and a deceleration in terms of the pace of growth, and that's a bit of a headwind. I think also you've got to recognize that long-dated bond yields are too low. We saw a squeeze since the June FOMC meeting in the bond market that's distorted the market. And if you look at the bond auctions that we've seen in the US this week, there's been weak investor demand. And that's a red flag that we think, and we're looking for bond yields to move higher. We can still see 10-year yields getting up to 2% by the end of 2021. And that's going to be a headwind, I think, to the equity market. So the equity market may not, in the US, may not actually make any real headway for the remainder of the year, despite sort of good corporate earnings. Consequently, we sort of tend to look elsewhere, like Germany and emerging Asia equities.